Welcome to the Merkle, where we showcase the experiences and learnings of only the best builders and investors in Web3. I'm your host, Yang, and let's kick it off. Welcome to the show. Today we have a pretty interesting duo, Sam and Jordan, who have a wealth of experience in the tech M&A scene, a dynamic duo from Qatalyst Partners. And if there's an investment bank that kind of rhymes with entrepreneurship and tech, Qatalyst is probably the one, having advised Figma on their $22 billion sale to Adobe, LinkedIn to Microsoft, and many more. Sam and Jordan, you've had a wealth of experience in traditional tech markets, and very excited to have you on the show.
Thanks for having us. We're excited too.
Here it reads that you guys have been in Qatalyst since the LinkedIn sale to Microsoft in 2016, which means you folks have been in the business for a pretty long time. I'd love for you to just start us off into your background in the tech sector, in M&A, and how you eventually found and transitioned into Web3.
Yeah, I worked at Qatalyst for about 7 years. I started there out of school, and the first M&A deal I ever worked on was the sale of LinkedIn to Microsoft. And it was, you could spend a lot of time talking about the war stories from that, but it was definitely a pretty intense introduction to M&A investment banking. And was really fortunate to get there at a time when they were working on some of the coolest and most interesting deals in the M&A landscape in tech. And that's how Jordan and I met and became friends. And at some point in 2021, we both kind of looked at each other and we were like, we're either going to try to do something entrepreneurial now, or we're going to be bankers for the rest of our lives. And I think that the former sounded a lot more interesting than the latter. So we left Qatalyst at the beginning of this year, and we really were excited about crypto and blockchain technology. And I think we got into the space and we were really focused on M&A advisory. And we saw there's a handful of focused M&A advisors in crypto, but it's still very limited relative to the size of the market. And as we spent more and more time in the space, we ended up, I think the classic crypto origin story is you find something in the space that interests you and you dive down the rabbit hole and you go in 1,000 different directions. So Alastor is a financial advisory firm, and we think about our business in two vectors. We provide M&A advisory services to companies in Web3 and crypto, and we do strategy consulting for projects and protocols. And we've spent a lot of time with folks like Uniswap and Lido and Gitcoin and ENS. And it's obviously a really interesting time to be in crypto right now. But I think both Jordan and I are long-term bullish. And it's actually been kind of weirdly nice to feel like a lot of the sort of noise from people just looking to sort of get token prices that go up has gone away. And there's been a lot more focus on like building technology with valuable use cases. So that's, a little bit of our background.
Yeah, just to add on to that, I think like Sam had mentioned, I joined Qatalyst actually a couple of years after he did, and started my career at Citigroup, focused on just tech coverage broadly. So worked on Roku's IPO, worked on a couple debt deals before focusing primarily on M&A. And then, I think we've definitely gotten into the space very, very feet first, looking and working on a couple different M&A opportunities. But I think what's been really exciting is just how malleable the space is, how much opportunity there is to help and be a part of various projects in a more strategic sense, whether that is in an M&A context or in a growth-focused context. So I think we've tried to be very malleable and kind of focusing our business in a number of different directions. That's led us into a number of different assignments that are all very kind of distinct from one another.
Right, that's awesome. I guess we can start with the more nuts and bolts of how you guys plan to structure your business, and then we'll move on to like more broader themes in the crypto M&A space. What sort of clients do you think is the best fit for Alastor? Can you talk us through like who might benefit from your services?
Yeah, when we look at M&A, that runs the gambit from decentralized organizations to centralized organizations with and without tokens. I think that our perspective on DAO M&A I think we were quite interested in it. And I think there are a lot of reasons why DAO M&A might never be a thing, and where we can definitely go into that. And then as it relates to strategy consulting, we spent a lot of time with DAOs like Uniswap and Lido. And I think that there is a market opportunity, not just with decentralized organizations, but also with typical centralized organizations that are building blockchain tech, to leverage the data on the blockchain to make strategic and thoughtful decisions on very important business areas.
Yeah, just to put a bit of a finer point on that, I think that from an M&A perspective, M&A definitely cycles up and down with the market. I think that there's definitely, I would not be surprised if in the next kind of 6 to 12 months, given how many entities have fundraised, if folks are going to start looking for homes for their business, if there's going to be opportunities for consolidation. I think some folks with some pretty richly valued equity currency might be looking to actually go out and explore what they can pick up at cheap prices. And so I think from a sell side and a buy side perspective, I think that there are going to be a lot of opportunities there. But to Sam's point, I think that in the more near term, where we've been focused our time has just been noticing that how many projects have I would say, wealth of kind of product and technical expertise and a bit of a dearth of financial and strategic expertise. And so that's where, from a consulting perspective, where folks are really trying to think about, okay, how do we grow our business? How do we actually monetize in a way that is profitable and sustainable? Those are kind of the areas where, and the problems that I think we can help people solve.
You mentioned a lot of key themes there. I have so much I want to dive into. Now, maybe we can start with the point you mentioned about more M&A activity due to consolidation in space. Would you say that the overfunding of a certain sector, a thesis, or a narrative kind of precedes more M&A activity? I've seen my fair share of sexy or easy businesses, obvious ideas that come out in the early stage and things like, and people just raise money for those kind of things. Some of these may be commoditized, some may not, but it's a brutally competitive space. What is your view on that?
Yeah, no, I mean, I think these things definitely go in waves. I think if you look at even just where we came from, Qatalyst business, when Qatalyst started kind of ramping up their M&A business in the early kind of 2009, 2010, a lot of the deals they were doing were semiconductor focused. And it's because a lot of the funding, a lot of the companies that had sprung up in the kind of early tech days post-dot-com boom were semiconductor companies. You look today, a lot of the deals that they're doing are more software focused. And it's because the VC funding over the course of the last 5 to 10 years has been very software focused. I think our bet was in the long term, given how much money is flowing into the blockchain, into the crypto space. It's just a simple cause and effect. You get investors that want exposure to a given kind of macroeconomic dynamic, a given space. Those investors start pouring money in, they start fundraising to invest, and you get companies that pop up, and some of those companies end up getting big and going public, some end up failing, and others just end up combining with one another and kind of finding the most efficient way for the capital to be used. So it just is a general rule that funding tends to be the leading indicator when it comes to kind of M&A and consolidation broadly.
Awesome. Are there particular sectors or product spaces within crypto that you see more M&A activity popping up in the next few months to years?
We try to think about M&A and crypto in sort of 2 different vectors. And this is overly simplistic, but we look at like where there has been M&A or where there might be scale M&A. And we look at that as sort of like, Bitcoin mining. And I think a lot of these centralized exchanges will end up consolidating, right? There's been a lot of centralized exchanges acquiring licenses and digital technology. And we don't find that to be as interesting for us. We're more interested in where the puck is going from an M&A standpoint. So looking at deals like Uniswap buying Genie and OpenSea buying Gem, and some of the more like decentralized M&A use cases that actually get more to like fundamentally what the blockchain technology is. I think an area where there will likely be a lot of consolidation in the somewhat near term that is interesting is in the custody and wallet space, right? There's so many different wallet providers out there. It makes sense for them to join forces. I think you'll look at a lot of the centralized players that want to get closer to the decentralized applications and like what's the way that users access it? Well, it's with non-custodial wallets. So do they build that in-house or do they buy tech and teams to accelerate that? So that is our viewpoint there. But there's obviously a lot of other areas in crypto where there will be more M&A. Just unclear how near term it will be.
I think one thing just to layer on top of that is that the data and analytics that the blockchain enables are incredibly powerful. And you've seen a lot of different data and analytics providers kind of popping up. So I think like Nansen buying Apeboard, I think is an interesting example. I could see Nansen continuing to be potentially a little active there, maybe Masari as well. I think you see some of these well-capitalized data providers and lots of different tools that could make an interesting kind of tuck-in acquisitions. So that's no inside information. They're just kind of throwing that out there, but that's something I think could make a lot of sense.
Yeah, definitely agree with regards to the data point. The open source nature of the blockchain that just allows everyone to make their own analytics applications here and there. Some of which can exist as standalone businesses, but a lot of which are really just features that are waiting to be acquired by bigger players like Nansen. So a core piece of M&A, at least in the traditional sense, is valuation. And traditionally, maybe you do a DCF model, you spread precedent transactions, or you create some liquidation percentages for your assets. But these clearly don't map to the Web3 space. And many of these tokens today don't even have a source of cash flow. How then are you thinking about valuing a business in Web3?
It's a great question. I think that when you're talking about value, and this is true even in the kind of more early stage tech space, that when you're making big valuation decisions for kind of private pre-revenue or early revenue companies, it's a lot more art than science to begin with. It is a lot more to do with process and negotiation and potential synergies. It can be a little hand wavy, candidly, when you start thinking about what people are willing to pay. To talk about tokens specifically, I think there's a lot of reasons why token-based M&A is interesting. I think there's a lot of reasons, to Sam's point earlier, why I think maybe we're a little ways away from that being kind of a mainstream thing. I think, to your point, given the kind of decentralized and non-securitized nature of tokens today, you're generally speaking, tokens aren't tied directly to cash flow. They're tied kind of indirectly in some cases. They're more tied to governance. I think there's a lot of questions around how inherently valuable governance alone is. And so I think that to the extent that there are tokens that are tied to actual cash flows or presumably tied to the ability to kind of control and direct cash flows, I think you can make similar-ish valuation decisions, similar-ish valuation frameworks. But I think a lot of that book is just yet to be written. And a lot of it is regulatory overhang, candidly. So there's a lot more, like I said, a lot more art than science and a lot more to be kind of figured out there. But I do think that token M&A is not too distinct from like public equities M&A in that sense.
Yeah, I agree with all that.
Gotcha. That makes sense. And to add on another layer of difficulty in conducting strategic advisory or M&A advice in the Web3 space is that there aren't very transparent or at least systematized reporting procedures in the crypto space. There is no balance sheet, there's no income statement. Very few projects have proper operational procedures for reporting these kinds of things. What is your view on that, and how do you think we can improve to push this forward in the space?
It's a great point. I think one company that is doing a good job of this is Masari. If you look at the work that they're doing with a bunch of DAOs and crypto projects in terms of just publishing quarterly reports with standardized financials and hosting analyst calls. It's this type of stuff. And this was kind of one of our driving theses getting into the space, is that ultimately a lot of these frameworks that exist in TradFi exist for a reason. And there's a reason why companies publish financial statements. There's a reason why companies publish forward-looking guidance. It's so that investors, and in crypto it would be token holders, can have a accurate perspective on the company's financial performance. And that is obviously driving a lot of investment decisions. So I think that is something that will happen. It needs to happen. It's sort of in process. But in order for tokens to become something that institutional capital flows into, there needs to be more financial transparency and reporting, for sure.
Awesome. So you mentioned a few recurring pieces of how you see the M&A space is going to play out and whether you see consolidation in some sectors or not. And I suppose that even as you're running an advisory business, there are some directional theses that you identify and want to capitalize on. So I think in my largely uninformed view, for example, in Qatalyst, when Adobe acquired Figma, it's really like enterprise SaaS software kind of business trying to break into a web native, collaborative kind of application space that serves younger crowd, smaller teams, more entrepreneur focused teams, and they acquired Frame and Workfront in a similar pattern. Do you have such directional thesis in the Web3 space? I'd love to explore that.
Look, I think digital custody, non-custodial wallets, that's an area where there will be more consolidation. I think data and analytics vendors, there will be consolidation there. I think looking at companies that are trying to build an independent enterprise stack, like a Chainalysis, there's a lot of M&A that they could do in the space. I think fundamentally what is inhibiting M&A right now is the fact that acquirers are in defense mode, and that ultimately companies are bought, not sold. And until there is a cohort of well-capitalized acquirers in crypto that are willing to act aggressively and acquire, there's not going to be much M&A. And the sort of incremental point on top of that is also looking at Web 2 players that are going to use M&A to get into the space. So obviously, eBay bought an NFT marketplace. There's been a few other examples of that. That, from my perspective, will be the catalyst that drives a lot of M&A in crypto, is when you have guys like PayPal and Visa and traditional Web2 players that view M&A as the way that they're going to get into the space. And right now, I think we're a bit a ways from that.
Yeah, I think a lot of people, one of the traditional tropes of M&A is not that like high valuations or low valuations in either sense are the enemies of M&A. What it really is volatility. And I think the volatility you've seen over the last 6 months has definitely made people wary. I think some of the more negative PR trends have definitely made Web2 players, I would say, more wary than they would have been otherwise. And so I think there's going to take a little bit of time for that to recover. That being said, I do think that there are a few kind of well-capitalized Web3 players that are trying to solve very specific problems. I think we mentioned data vendors earlier. I think that's a big one. What Sam mentioned around kind of like an enterprise tooling and roll-up strategy, I think that makes a lot of sense. And then I think lastly, I think something that you've seen that's been really interesting is people trying to kind of own the on-chain onboarding ramp. You saw obviously FTX and Coinbase and other exchanges have effectively become on-chain onboarding for traditional and retail capital. I wouldn't be surprised if there are more acquisitions in the space kind of in and around that theme. How do we basically democratize the ability to get capital, to get folks on chain? That's probably a more, Q4 of next year or 2024 type theme, but I think that is going to be a near-term theme as well.
Yeah, and then last point on that, I think one broad theme that is kind of very related, if not the same to what you just said, is basically sort of blurring the lines a little bit between what is decentralized finance and what is centralized finance. So that is OpenSea acquiring an NFT marketplace aggregator in GEM. It would be, what Uniswap's doing right now with some of the dev work they're doing with GFX Lab to put together a trading interface that looks a little bit more like a centralized exchange. So I think that broad theme is one that will play out over the course of years, but will drive M&A for sure.
Yeah, I guess that points to something that a lot of VCs also think about as to what sort of services have to be bundled together in order to properly monetize. If OpenSea, as the owner of the liquidity of the underlying NFTs, they don't own their customers because all the customers go to the front end of GEM or Genie, because Genie is supposed to provide best execution. It aggregates all the liquidity across all the exchanges, then OpenSea pretty much just becomes commoditized as a layer. In my view, it made sense for them to kind of forward integrate in that sense. Curious to hear if you see like any other of these sort of vertical integrations playing out around the crypto space.
What is interesting when you look at a company like a Uniswap, right? Understanding the delineation between what the Uniswap protocol actually is and what the Uniswap front end is, and how the protocol can generate fees based on effectively the take rate that get diverted into the treasury versus the labs entity needing to monetize the front end. So you look at Uniswap acquiring Genie, and that was Uniswap Labs, and they would monetize that through the front end. Looking at other things that the Labs entity can do around LP tooling and making it easier for institutional capital to deploy liquidity on the Uniswap platform. These are all things that I think that decentralized protocols that have a front end with a Labs entity are going to figure out over the next few years, is how to monetize that front end above and beyond just the revenue that's being generated from the protocol into the treasury. And a lot of that will happen through M&A.
Yeah, and I think just to layer onto that further, something that obviously a lot of negatives about the market over the last 6 months. I think one of the positives has been how focused it has made builders and venture capitalists on profitability and value accrual. I think that there has been a lot of innovation over the course of the last 2 to 3 years that has been entirely focused on, let's build cool shit. Let's try and grow our user base. Let's kind of play around with these different token fundraising models, et cetera. And I think you've seen some stuff that has been built that has value, that has stuck. But I think you've seen a lot of stuff built that really hasn't. And I think that over the course of the next, call it 6 to 18 months, I think you're going to see a lot of people start shifting their business models and shifting their sites a little bit towards, okay, how do we actually use this to accrue value? And again, like Uniswap Labs is an interesting one. I think obviously like Safe, I think is another interesting one where you have these different products that are being built that actually aren't currently being monetized, but are being widely used. Okay, well, in order for innovation to continue in the space, there does need to be value accrual to equity holders. That is just how the game works. And so I think folks being able to crack that nut and focused on cracking that nut and using M&A as kind of one of the few tools in the toolkit to make that happen, I think is something you'll see a lot of.
Definitely agree with that. It's always fascinating to think about how in a structurally open source environment, how exactly you are going to monetize and how you actually accrue value for the work you are doing. This gives us a really nice segue to a case you guys have been working on, strategic advisory to Uniswap. I briefly read the report that you have posted, a very data-driven one. But I love it if you could share with our audience, talk it through some of the key insights that you found, and maybe like what you'd like to see Uniswap V3 going forward from here.
Yeah. I mean, these are really interesting assignments. We received a grant from the Uniswap Foundation, just to give kind of a little bit of context for your listeners. Uniswap governance is obviously the kind of uni token holders that have been making a decision about whether or not they're going to start taking a take rate from their liquidity providers on their platform. So today, all of the fees that run through the Uniswap platform go back to liquidity providers who effectively power the automated market maker. And so there'd been a lot of debate, and basically kind of where the forums had landed was like, well, we should do some experimenting, but there was a lot of debate about where do we experiment? How do we experiment? Should we just like put a broad fee switch on everything? Should we start on a different chain and not do an Ethereum-based chain pool? Or like, there's lots of debates, and I think there was very little cohesion to the conversation. And so we received a grant to do a little bit of data-driven work and provide a recommendation strategically. Here's how, if we were in charge, here's how we would do it. And here's the pools that we would focus on. And here's the order in which we would start a pilot program and then broader rollout and et cetera, et cetera. Definitely not like, I wouldn't say like kind of comprehensive and definitive in that ultimately uni token holders need to make a decision, but the idea was to put forth a little bit more of a framework. So our ultimate recommendation was to start on Ethereum-based pools that have enough scale that you can actually draw conclusions from, focus on actually using the fee switch as an incentivization tool to move liquidity from higher fee tier pools to lower fee tier pools and actually make the protocol work more efficiently. And so being able to actually both monetize and hopefully grow volumes at the same time, which I think is a little counterintuitive and we thought was pretty interesting insight from the work that we did.
Yeah, and then I think even if I could ask a question to Jordan, what is the rationale for Uniswap to want to move liquidity from the higher fee tier pools to the lower fee tier pools?
One thing that makes Uniswap very distinct from anything else. If I'm a trader, I can go trade tokens on, I guess I can't trade tokens on FTX anymore. I could have traded tokens on FTX, but I can go trade tokens on Coinbase or Binance, or I can go on chain and I can trade them on Uniswap or SushiSwap or what have you. And if I feel very ideologically strong that everything needs to be in a decentralized manner, well, then maybe I'll trade on Uniswap or an aggregator like 1inch or whatever, and I'll never trade on a centralized exchange. Well, I think most people don't actually have those strong of kind of ideological values. So in general, they're going to make trades where it just financially makes the most sense to them. I think that's especially true when you start thinking about institutional traders that actually drive the majority of trading volume, both on-chain and off-chain. And so what makes Uniswap really interesting is the cost of actually trading on the platform is totally dependent, particularly in large sizes, is totally dependent on where the liquidity lies on the platform. So Uniswap has multiple fee tier pools in a given pairing. So if I'm going to go trade ETH for USDC, the Uniswap router is going to route my trade through the cheapest fee tier pool. And then once it's run out of liquidity and the slippage is sufficiently high that it's going to be too expensive, it's going to reroute me to the next highest pool. And after that, the next highest pool. And with the distinction that at some point, sometimes it'll make like multiple pools and I'll get charged twice, et cetera, et cetera. And it's set up to give me the cheapest price possible, but where the liquidity lies on the platform totally depends on how much it's going to cost. Whereas if I go and trade on Coinbase, I'm getting a flat rate based on the volume that I trade on the platform all the time. And so what that gives Uniswap governance the power to do is, to the extent that they can use the fee switch as a tool, they can start shifting around liquidity and effectively saying, here's how we want to price this pairing versus that pairing. That's a little overly simplistic, but that is kind of the idea, is you can start making it, if you're like an economics person, you can start making it, perfectly efficient, kind of like how airlines will price flights differently depending on where you're going and how close you are to your flight, et cetera, et cetera. You can actually find like a very efficient world in which you're pricing everything and capturing as much value as possible.
And what was interesting about our analysis is we looked at the trading pairs where Uniswap had the highest market share versus other decentralized exchanges and centralized exchanges. And the pairs that they had the highest market share in were pairs where it was the cheapest from a fee perspective to trade in. And given that Uniswap is such an early stage company, when you think about it, they're like a Series A, Series B company, the objective for Uniswap should be to drive market share and growth. So if Uniswap can incentivize liquidity to move into lower fee tier pools and make it cheaper for volume to get routed through Uniswap, they should grow market share and volume. And that should be, from our perspective, their core objective given the stage of the protocol.
Right. Interesting. I'm curious to hear, just to push this idea a bit further. I know like we're still in kind of even the early days of AMMs and business models are really not yet defined. But just to push this idea a little bit more, how do you see the respective strategies of AMMs that are automated market makers that are competing with Uniswap? So, for example, Curve, where they have a mechanism for people to lock up their liquidity for a certain period of time, or use their token as a liquidity incentivization mechanism that allows people to deploy new pools and incentivize liquidity for that pool.
It's a great question. I think what we've seen, and this will not be the case a year from now. I think a year from now, you'll have seen crypto changes so fast, right? So the way that Curve has, again, this is outside looking in. I don't know anyone on the Curve team, but the way that Curve seems to have attacked the market is to think, okay, from a Uniswap V2 fork perspective, so just a primarily flat, non-concentrated liquidity AMM, which is basically every AMM on the market other than Uniswap V3, which just simply means that people provide their liquidity and you're not choosing price points between which you're providing liquidity, which causes the liquidity to be all treated equally and thus incredibly, I would say, very broad and very shallow. The way that Curve has gone about their business has been, okay, like we will incentivize people to, like, the more liquidity you can have, the more efficient your AMM is going to work. And thus we're going to incentivize people to lock as much capital on the platform as we possibly can. And thus the slippage from trading on our platform is going to be relatively low, which is true. Now, the way that Uniswap attacked it was a bit different when they released V3, and notice how they put a license on V3 that they didn't have on V2, which made it theoretically unforkable, or like legally so. I think there were a lot of people that were skeptical that it would actually not get forked, but to date, it actually hasn't been forked, which I think is pretty interesting and I think very instructive moving forward. But they attacked it with a more technological issue, using concentrated liquidity, allowing people to provide liquidity in specific ranges, getting their liquidity deeper. And so you can actually see this in our report. We show like, okay, here's how trading volumes break down across all of your top AMMs in Ethereum, and here's all of your TVL breaks down. Curve has a ton more TVL, but not nearly the amount of trading. There's a lot of reasons for that. One of the big reasons is that Uniswap simply has deeper liquidity because of their concentrated liquidity technology.
Right, gotcha. I suppose that makes sense. There are a couple of DeFi protocols out there, and there are some that are moving more towards and kind of, like you mentioned previously, a more institutional strategy. Let's say Aave, they provide a garden wallet solution for KYC, institutional accounts to interact with each other. Do you see this extending to any other sector in the space? It doesn't have to be just AMMs, anything else.
I think just broadly, that's going to be what has to happen. I think that they're capturing retail capital for any kind of financialized product is like a good starting point. But I think for you to really kind of become mainstream usable, you need to be able to adhere to, you need to be able to cater to institutional capital. And that's true for a lending protocol like Aave. I think that's true for any trading protocol like Uniswap. I think that's going to be broadly true kind of always, at least in the near future. And I think that's something that is when we talk about kind of go back to the kind of merging of on-chain and off-chain worlds, I think that's going to be something that on-chain protocols are just going to have to grapple with. How do we make our product more accessible and more easily digestible for institutional capital, maybe less crypto native institutional capital to get involved?
Yeah, that makes sense. This almost reminds me of Red Hat and MongoDB, where they monetize primarily through their enterprise offering and offering white glove support to their initial set of enterprise customers.
You see it all the time where folks are always trying to move, in the software space, at least people are generally speaking trying to move upstream. That is the type of volume that is stickier, it's bigger. It makes a lot of sense why folks are generally thinking about it that way in the off-chain world.
All right, moving on more towards the other sectors in the space. The NFT space has kind of been grappling with a few strategic problems lately, one of which had to do with the charging of royalties, where you see a lot of marketplace removing creator and force royalties because everyone was going off to other marketplaces that didn't enforce royalties. How do you see this entire NFT marketplace space playing out?
It's a fantastic question. I think that you're seeing NFT marketplaces are having to grapple with the three different constituents that make up the lifeblood of their business, which are the buyers of NFTs, the sellers of NFTs, and the creators of NFTs. You see folks like On the Solana side of things, like Magic Eden, obviously they wanted to cater to creators and eventually ended up bending to the will of the sellers. And the rationale there simply being that ultimately those are the end users. Those are the people that are actually paying you. You see how I think another good example is like what JPEGs is doing over on the Avalanche side of things and how they're focused on actually bringing creators in-house. Obviously, Avalanche as a chain is very focused on being creator forward and thus being very pro-royalty in that sense. So it's a balancing game. And part of the problem is the fact that royalties really can't be enforced on chain because you're able to wrap up the NFTs and trade them that way. And it ends up kind of blocking the royal. And I'm not incredibly technical, but my basic understanding is that isn't enforceable. So I think you're just simply having to kind of balance the constituents. I do think that what JPEGs is doing is really interesting. And I think that could potentially be a model that you see where the differentiation becomes less about price and cost and more about in-house creators and thus kind of NFT availability. That would be kind of I would say like an early stage trend that I've noticed that I could see kind of continuing, not too dissimilar to like the streaming wars and people trying to bring content in-house when you think about like what Netflix did and Hulu and HBO Max, et cetera, et cetera.
Gotcha. In a traditional sense, an M&A advisor kind of mediates the deal between the buyer and the seller side, and maybe the seller engages with an advisor. The buyer also has an advisor, an internal M&A team that carries out the entire process. But right now in the crypto space, it's either very open because you have a DAO and you have to submit everything to an on-chain vote, or it's very closed doors if you're talking about early stage investments and everything occurs peer-to-peer on Telegram or something like that. How do you see the space evolving? Would you see it evolving to a traditional world?
I think it will converge to something that is a lot more similar to what happens in TradFi or Web2. I think decentralized M&A, DAO to DAO M&A is really, really challenging to do properly. I mean, the sort of M&A deal that got us sort of the most interested in crypto M&A and DAO M&A was Ferrari. And I think if you look at how that is played out, right, it's kind of shown why it is very challenging to do decentralized M&A. To give one example, like the hack of Rari post merger, there was no escrow mechanism in place. So the tribe token holders weren't indemnified against that loss. So they had to just basically hold the bag for the hack. Now, in a typical M&A deal, there would be an escrow that was 10 to 15% of deal value that would release over 6 to 18 months. And that didn't exist on chain. And I think what's interesting is you look at an escrow and the technology to actually power. Jordan and I have dealt with many sort of paying agents and escrow agents from our Web2 M&A days. And it is such a manual process to actually put together a payment spreadsheet, send out quarterly payments to the different shareholders of the target being acquired. But you could totally see how an escrow makes a lot more sense to be deployed on chain. And you send a percentage of the funds into a smart contract that just streams the escrow over time to other smart contracts. It's trustless, it's permissionless. You don't need to pay an escrow agent. So that's an example of where I think blockchain tech can be used to make M&A better. As it relates to the actual M&A advisors, I think that DAO M&A, I would say I'm bearish on. Typical M&A for companies in crypto will converge to a more typical buy-side M&A advisor, sell-side M&A advisor relationship over time.
Yeah, I think one caveat I would make to that is that I agree with Sam in terms of the way that DAOs function today. Would say that I am bearish on, and from like a token-based DAO to DAO M&A, I could see a world in which DAOs are run a little bit more like traditional organizations in the future, and token behaves a little bit more like traditional equity. It doesn't necessarily need to be one-to-one. And in that case, I could see that becoming a larger piece of the pie. It's so tough. I think we are at a really interesting inflection point with decentralized governance to see kind of where that goes in the future. So I could see that evolving to be a little bit more palatable from an M&A perspective. I think one broad point I want to make just before we move on is that I think this is true in DeFi, maybe not crypto broadly, but in DeFi specifically, that a lot of times we are kind of reinventing and relearning a lot of traditional financial rails. And I think some of those DeFi actually finds ways to do better and more efficiently, and others you simply look at it and you say, okay, well, this is the way that was done this way the entire time. And I think M&A advisory is one of those. I think just having been in it for a very long time, I think there are some, to Sam's point, when it comes to like escrow agents and whatnot, where you can do a lot of blockchain automation that I think could get really interesting. But I think simply from a like human element of advisory and a human element of negotiation, I think there's a reason that it is done that way off chain. And I think that will probably continue to be to some degree the case on.
Fantastic. So for a project who is, I suppose, looking for strategic advisory services, looking for help with M&A, what's the best way to get in touch with Alastor?
You can reach out to us, info@alastor.oo. Also just on Twitter, where Jordan and I are both relatively active. Maybe we're not as active as some other people. But look, I think that hiring an M&A advisor, particularly on the sell side, on the buy side, a lot of these companies, and we could go into buy-side M&A advisory in crypto because I think it's a little bit different. But, we did so many deals at Qatalyst where, a serial acquirer almost never hires a buy-side M&A advisor. They'll hire a bank to provide financing, so for their capital markets expertise, but not actually for the M&A advisory and execution. On the sell side, we're obviously very biased as, we've done a lot of sell-side M&A advisory. We've seen so many companies shoot themselves in the foot by trying to negotiate an M&A deal on their own and just go about it incorrectly and overshare information up front, be a little bit too candid that maybe they're bearish about their company's prospects and they, need some help from an acquirer, right? The scripting and the negotiation and how you actually present the data that you share to show your company in the best light. When you actually look at the cost of an M&A advisor, if they're a good M&A advisor, they should pay for their fee many times over, because if you negotiate a deal properly, you're going to drive a significantly higher price tag for your client. And, advisor gets paid, company gets paid more. And what you'll see a lot of times are acquirers put pressure on sellers. Oh, you don't need to hire a banker. Oh, bankers are they're just going to make the process more difficult. And look, if Mark Zuckerberg's approaching you and he wants to buy your company in a weekend for billions of dollars, like he did with WhatsApp, maybe you don't necessarily hire a banker, but there's that's the corner case. In almost all scenarios, an M&A advisor will be very helpful for companies, particularly when they've never gone through an M&A process.
Yeah, very great to have you guys on. It was a fantastic conversation and really enjoyed it.
Yeah, thank you so much for having us.
Yeah, thank you. Really appreciate it.
If you found this episode helpful, do give us a like and subscribe. Do put down in comments anything or anyone you'd like to see in this show. You can find me on Twitter or Telegram at YoitsYoung. That's YoitsYoung. Thank you for listening and see you soon.